Now we will review what we've presented in parts 1 and 2 of this movie. In doing so, we will be comparing today's system based on promises of payment in money with our proposed system based on promises of payment in real production. In the current system, money comes into existence when it's borrowed from a bank. The bank charges interest on top of principal, but the money to pay this interest is not created. Therefore, as we've demonstrated in Part 1, the bank must spend 100% of the money it takes in as interest, and this money must not be lent a second time. Otherwise, the debt becomes perpetual. Perpetual debt can never be eliminated or even reduced without causing a default. In this system, credit, that is the promise of repayment in money, is used as money. By using the promises of money as money, the distinction between money and credit has been lost. Yep, even explained many times, it still sounds like some upside-down logic from Alice in Wonderland. But it's even worse. Banks can issue new promises to pay money based on having existing promises to pay money, or on bets that someone will or won't pay, or on corporate equities, so that an enormous inverted pyramid of debts and bets can be based on a few debts at the bottom, like the most fabulous house of cards, all made out of, quote, unfunded liabilities. This unfunded liability money can fail dramatically whenever a large amount of debt is defaulted on, bringing the whole financial house of cards tumbling down. Unless the government steps in and puts the taxpayer in debt. That is, the government creates more unfunded liabilities to the tune of trillions to replace all this so-called money that was never anything but promises to repay something the banks never had in the first place. Nothing substantial is done to reform this perverse system, because those in control make out like bandits, raking in huge personal gains. Worse still, for us all, the crisis is used as an excuse to further consolidate the bandits' control of the money system. The very people whose wild irresponsibility and/or deliberate criminal intent, those same people who caused the problems, are given even more power and even more of our money. So it will all happen again and again. Without an alternative, we'll be helpless. We will have our happiness shattered, our freedom stolen, and our creativity wasted by greedy scoundrels who produce nothing but the illusion that they have the power to create money. But in reality, they don't. Why? For the simple, logical, and it should be obvious reason that if there was nothing of value to buy with their money would have no value. The only ones who have the actual power to create the value of money are those with the power to create real value in the form of real goods and services. The ones who create real value in the current money system are called borrowers, and they must repay their borrowing in so-called money. But for the most part, this so-called money isn't money at all. It's bank credit, a form of debt that can only be created by banks, the supply of which is thus limited and controlled by banks. In complete contrast, the self-issued credit system creates money as a promise of delivery of the goods and/or services of an issuer, not a borrower. As such, it's real money or hard money, a positive quantity, not a negative quantity like the debt of money. It can be created by anyone who can back it up with real goods and services in demand. And it is payable only in goods and services. This ensures that the promise can only be collected on by hiring or purchasing from the issuer who made the promise. Accepting an issuer's credit over time would be materially rewarded, as in the current system. But this material reward, whether regarded as interest or dividend, would be payable in products or services only, not in money. Therefore, the arithmetic problem created by conventional money interest, that is to say, being compelled to pay back more money than was created, would no longer form the basis of the money system. Issuers would pay this interest or dividend to their customers by redeeming their own mature credit in product at a higher value than any other. This would create the motivation for the issuer's credit to flow back to the issuer at the maturity date, just when the issuer planned that it would. By means of a free market, purchasers would trade the various issuer credits in their possession for the mature issuer credit of their choice. They would then reap the benefits of a lower price when they purchase the products or services of that issuer. Exchanging for maximum value credit would happen constantly at the wholesale level, where getting the absolute best deal possible would be a competitive imperative. Individuals would almost certainly do the same when making large purchases directly from an issuer, as the savings would be well worth the effort. Unlike the current system, which is technically bankrupt at all times, this proposed system eliminates conventional bankruptcy for the issuers of credit. In this proposed system, poor issuer business simply means below par credit. Profitable issuer business means above par credit. In either case, the required action is to match spending with demand. And if this is not done deliberately, the system's arithmetic does it automatically. There's no escape. However, unlike the rigid payment schedules in the current system, there would never be any pressure to sell a minimum amount of products or services within a certain time to satisfy the fixed conditions of a bank loan. And should an issuer's credit lose some or all of its value, the loss is immediately socialized via flow amongst those who voluntarily accepted that issuer's credit. How? Simple. Flow works just as well in distributing losses as it does in facilitating trade. Devaluing credit could be a hot potato set up by the software to be spent first in every transaction. Flow could, therefore, spread imperceptibly small losses amongst a very large number of people, harming no one. It would be straightforward. It would not threaten the collapse of any bank and the loss of depositors' savings. Nor would it require government intervention with taxpayer-funded bailouts laying astronomical debts upon future generations. Quite the contrary. The unavoidable loss of value would be taken care of immediately by an organic, somewhat random, and entirely voluntary process. Where's the justice in that? There's justice in this arrangement because producers are trying to supply us with what we need and want. Consumers would have nothing to consume without producers, and producers would have no one to produce for without consumers. So, in reality, consumers and producers are indispensable partners for each other. So why should the producers take all the risk and the consumers take none? If we think of farmers, the concept should be clear. If they don't grow food, we don't eat. That's a fact that today's spoiled consumers should reflect on before every meal. So given our total collective dependence on farmers, why should farmers have to enslave themselves to banks in order to feed us? Where's the justice in that? In a self-issued credit system, farmers could form cooperatives to support each other and issue a common credit currency themselves as claims against their harvest. All those who eat would accept their money and become shareholders in these harvests. Thus, an engaged and mutually supportive social arrangement would be created. Without shoemakers, we'd have no shoes. Without automakers, no cars. Regardless of our race, politics, or religious beliefs, we're all dependent on the same basic necessities of life. In a self-issued credit system, holding an issuer's credit would be a form of shareholding in the issuer. So to that extent, everyone would be a shareholder in a variety of enterprises at all times. To hold shares is to share risk. This would sometimes lead to losses of value, since losses can't be avoided in any system. But in this proposed new system, they would be immediate losses. They would not turn into perpetual and unpayable fantasy debts dumped onto future generations. If widely adopted, self-issued credit could transform society in many positive ways. Issuers, their employees, and the non-issuer economy in which the employees spend their pay would all have a common interest in maintaining the value of their local issuer's credit. This would be particularly true because to stay within their business plans, issuers would have to value their own credit at par when they pay their employees, regardless of the actual market value of their credit. If the issuer was spending more than it was earning, the market value of its credit would sink below par, and the issuer's employees would find the real purchasing power of their pay reduced proportionately. This cut in pay would also apply to the issuer's executives and shareholders, as well as everyone else, near and far, that was holding that issuer's credit. This would result in more public engagement with, scrutiny of, and pressure upon corporate decision-makers. In this proposed new system, the fundamental change in paradigm is that money comes from within, not without. Any community with the resources and resourcefulness to create value could create its own issuer money to represent that value. No disapproval from a bank or government, no shortage of money, no banking crisis, near or far, need stand in the way. And, as an issuer, if you can maintain your balance of trade, then your credit is at par. The actions of others, even reckless governments, can have no direct effect on the value of your self-issued, self-maintained, and self-reliant credit. A basic rule of this new system is this: unless an issuer's credit has been voluntarily accepted, it is rejected. Very simple. No private credit money can ever be forced upon us. However, if the self-issued credit system were fully adopted, governments at all levels would be among the largest issuers of credit, that credit being payable for taxes. Like other issuers, government would honor its own credit at a higher value than any other, so it would be naturally advantageous to acquire government credit to pay taxes. There would be no need to make it mandatory to acquire government credits. Unlike private issuers, government would still have the exceptional powers of a ruling authority. For instance, government would still be able to compel its customers to pay for its services, without them being priced or even accepted in a competitive market. As well, government would very likely continue to have a monopoly on issuing physical cash as part of its credit issue. Legal tender status would have to be retained for this physical cash to ensure that those existing on cash outside the digital world could pay their debts with it. These are the exceptional powers that are reasonable to allow a duly constituted government to have. And it's unrealistic to expect government to ever surrender them. Outside of government, private enterprise issuer credit would be as competitive as the goods and services it represents. Its value would be established by the pricing of real goods and services, as value always ultimately is. And its parity with the universal unit would be indicative of the issuer's success in matching spending to demand. The evidence would be plain for all to see in the issuer's credit record. Voluntary acceptance of issuer credits would also make it possible to boycott an issuer's credit as well as its products. This would make credit boycotts an additional nonviolent tactic of social struggle. Using a single common money unit does not make such a system a monopoly. Why? Because this is not money as a single uniform commodity. It is money as a measurement unit of value. Instead of a limited supply of dollars from a monopolistic source like banks or government, there would be an indeterminate supply of product credits expressed in dollars. This proposed new system is designed on the absence of any central control like that of a gold reserve or a central debt dictatorship, such as the International Monetary Fund or the World Bank are now calling for. It would, in total contrast, be a spontaneous network of networks, a living multitude of interwoven systems, like nature itself. As all relations would be voluntary, such a system would grow just as the social networking systems like Facebook and Twitter have grown, organically and under no one's control. All such networks could be as locally limited or globe-spanning as the participants require. For major industries and governments, credit acceptance could be very general, amounting to a de facto decentralized global currency, arising naturally and spontaneously from real productivity. Compare that with what we have now, an unstable, unredeemable currency created by various acts of outright fraud imposed by the top-down machinations of an invisible and unaccountable banking elite and their paid-for agents in government. These guys control billions of people through debt because our minds are mired in the false belief that bankers have money. Is it not time we the people woke up and made better choices?